Let's walk through comparative company analysis like you're talking to a colleague over coffee. Practical, step by step, and focused on what actually moves the needle. Why you do it. It's a quick, market-driven way to value a company or check whether a stock looks cheap or expensive relative to peers. Instead of trying to forecast everything, you use how the market prices similar businesses as a benchmark. Core steps 1. Define the peer set. Pick companies that share business model, growth profile, margins, geography, and capital structure. Don't force symmetry. Better a smaller, tight set than a big, noisy one. 2. Choose metrics and multiples. Common ones: EV/revenue, EV/EBITDA, EV/FCF, PE, PB, and growth-adjusted multiples like PEG. Industry-specific metrics matter. Active users, ARPU, GMV, subscribers, or assets under management, and net interest margin for banks. 3. Normalize financials. Align fiscal periods, convert currencies, adjust for one-off items, restructuring, litigation, big sales, and make sure you're comparing underlying operating performance, e.g., EBIT or EBIT, not GAAP quirks. 4. Calculate multiples consistently. Use the same definitions across the set. Enterprise value should include debt and exclude excess cash by the same rule for all companies. EBITDA should be defined consistently, etc. 5. Look at central tendencies. Compute mean, median, and maybe quartiles. The median is often most robust to outliers. 6. Apply to your target. Multiply your target's metric, e.g., next 12 months EBITDA or revenue, by a selected peer multiple range to get a valuation range. 7. Sensitivity and sanity checks. Run a few scenarios, low, median, high multiples, different growth assumptions, and check against other valuation approaches like DCF or precedent transactions. What to watch for? Common pitfalls. Wrong peers. Fast-growing niche players versus large diversified incumbents will skew results. Unadjusted one-offs. Big non-recurring gains or losses can wildly distort multiples. Accounting differences, capitalization policies, revenue recognition, leases, these can change EBITDA or equity metrics. Size and liquidity premiums. Smaller or less liquid companies usually trade at discounts. You may need to adjust multiples. Growth mismatch. A single number, multiple, ignores future growth, so match multiples to similarly paced growth profiles or use growth-adjusted metrics. Which multiples to favor by industry? Techs, SaaS, EV, revenue, EV, EBITDA, EV, subscribers, Rule of 40 context. Consumer retail, EV, EBITDA, EV revenue, gross margin comparisons. Industrials, EV, EBITDA, PE, and return on capital metrics. Banks financials, PB, ROE, net interest margin, efficiency ratios. Real estate, NAV, price per square foot, cap rates. Qualitative overlay numbers don't capture everything. Consider competitive position, customer concentration, pricing power, regulatory risk, management quality, and product pipeline. Two companies can have the same EV/EBITDA, but very different risk profiles and upside potential. Data sources, company filings, 10K, 10Q, investor presentations, Bloomberg, Capital IQ, FactSet, Yahoo Finance, and industry reports. Always cite and timestamp the data you use. Presenting the result, show the peer table, highlight medians and ranges, explain key adjustments, and give a valuation range with your chosen multiples. Be explicit about assumptions and show sensitivity to different multiples and growth scenarios. Quick example, informal. If peers trade at a median EV/EBITDA of 10x and your target's normalized EBITDA is $50, implied enterprise value is $500. Subtract net debt and adjust for dilution to get implied equity value per share. Then test what EV/EBITDA of 8x or 12x would imply to capture uncertainty. Bottom line. Comparative company analysis is fast and market reflective, but it's only as good as your peer selection, normalization, and judgment on differences. Use it as a primary sanity check and pair it with other valuation methods and qualitative assessment for a rounded view.